And yeah, like I said, I'll be diving into the first entry module, just the first entry module. That is, in this case, it will be the inducement sweep entry module. And so I said also I will not be considering the lower time frame execution in this part. I will only be focused with the direct entry. By time or on something, I don't know, they whatever there is where we'll be talking more of lower time frame execution, but now I will only be doing the direct entry based on the same time frame, right? So right here, as you can see, the heading entry module number 1, inducement sweep entry module. And we all know that inducement, obviously abbreviated as IDM, like is divided into two. There is major inducement and minor inducement, and I want to believe that by now you all know how to distinguish between the two. You all know that a major inducement occurs after a break of structure. It doesn't matter if bullish or bearish. And a minor inducement occurs before that break of structure, but the context of inducement is actually the same. The recently formed valid pullback, the liquidity resting at that high or low, that's the inducement. Right, so major or minor, just like in English context, like in general, major is more significant as well as more impactful, just like in English. And so is in trading, the same is in trading. Like trades involving major inducement are always like will always be of more significance or like more impactful compared to the ones that involve the minor inducement, meaning the odds of winning the trades that involve major inducement, their odds of winning are high compared to the ones or compared to the trades that involve the minor inducement. But this doesn't mean that the ones involving the minor inducement don't work. No, both of them do work. The trades that involve the minor inducement and the trades that involve the major inducement. It's just that the odds of winning is different on the trades that involve the major inducement, because like by different I mean their odds are high, and the ones that involving the minor inducement, their odds are low. And I just explained it here using an English context that major is more significant as well as more impactful compared to minor. So this just explains it itself why the trades involving the major inducement are more impactful or have a higher odds of winning compared to the ones that involve the minor inducement. Alright, so on the inducement sweep entry module, it doesn't matter if it's a sweep of the major inducement or a sweep of the minor inducement. It's an inducement sweep entry module because both the major and the minor inducement, they are all inducement, so they are all valid, meaning a sweep of major inducement is also valid just like a sweep of minor inducement. But this sweep of major inducement is more like has higher odds of winning or is more impactful compared to this sweep of minor inducement. So this, in other words, meaning that in other words, it means that if you only focus with trades that I mean the inducement sweep of the major inducement, if you only focus with those trades that sweep the major inducement, then you will end up increasing your win rate rather than combining the two, or rather than actually taking the ones that involve a sweep of the minor inducement. So if you want to increase your win rate, you can decide to restrict yourself from taking those minor inducement sweeps and only take the major inducement sweep. This will increase your win rate. So it's actually depending with your whatever. So if you are good with going with both of them, like sweep of major and minor, that's fine. If you're not good with that, then and maybe you just want a good win rate, of course we know that a good win rate will always keep you psychologically intact. So I would advise you to just stick with the minor and restrict yourself with the minor. I would just advise you to stick with the major inducement sweep and restrict yourself from the ones that involve the minor inducement sweep. So with that said, then let me dive into the real chart so that we can get the real context. All right, so right here, this is USDJPY, one of pairs that I recommend if you do trade through SMC, because they work best through SMC. Yeah, them with other pairs, of course you need them. So right here, we all know this pattern. This is a bearish scenario. Price took out the recently formed valid pullback high. We know that buy side liquidity resting above there. That's what we call the inducement. In this case, a major inducement. And we can clearly see price retraced, took out that major inducement. We said once that happens, this one here is a low. And then after that, we can clearly see that price reversed all the way, breaking past that confirmed swing point. So this means that this one here is a valid bearish break of structure, and obviously we're now in a new trading range starting from that high and currently ending here, but this here is not a confirmed swing point because the inducement is yet taken. Alright, so the most important thing was to identify our current trading range, because we all know we identified the inducement on our impulsive move or our current trading range. Alright, so right here we can clearly see that this here is the recently formed valid pullback, and also we can see that that recently formed valid pullback occurred before this bearish break of structure. So this literally means that this inducement, of course this is an inducement, so that inducement is a minor inducement, and I said their odds are less. All right, anyway, let me run price. Let me do this. All right, so let me run price and see. All right, you can see price did this. All right, this is something that I wanted to say. That's a minor inducement, and if you do remember, I said that if a trading range involves a minor inducement, obviously the external liquidity will be the major inducement. So you can clearly see price stretched through the minor inducement, but let's see if price will break past this external liquidity, I mean past this trading range high, or will just sweep this external liquidity, of which is the same major inducement. All right, remember this here is a major inducement, but at the same time is the trading range high. So this means that if price breaks past this high with a significant body closure here, or with some displacement, this means that this one here will be a change of character or a bullish break of structure. But if price sweeps this part, meaning it just wicks above and gives that immediate rejection, then that will be a valid sweep. All right, so I believe you know why I used this one here as a major inducement. I explained this literally on the two I don't know, but yeah, maybe three sessions. I was very deep on this that we had before. So right here, this is the minor inducement, and this one here is the external liquidity, at the same time the major inducement. We said if it involves the minor inducement, the trading range high is the major inducement, and that's the opposite in an uptrend. So that have that in mind. All right, so right here, let me continue running price and see if price will end up sweeping that high or sweeping that major inducement, or will just continue up and up and up. All right, so exactly here we can clearly see here price wicked above. This means that price just, you can clearly see here price wicked above and gave that rejection. So right here, after once you see this, once you see this has happened, the first thing that you need to do here is draw a line, draw a line on this week, right? Draw a line on that week and make sure that there is no any other candle that will pass through this. It doesn't matter if it will be a candle close or an inducement, as long as the candle, the next candle, will not go past this line, then the sweep is still valid. Then after that, now wait for a reversal confirmation here. So first thing, draw the line so that to make sure that there is no any other candle that will go past this sweeping candle high, and then now wait for a reversal confirmation from this area. The reversal confirmation, it can be now the reversal confirmation, obviously they're the reversal candlestick patterns, because we are actually using the direct entry based on the same time frame, because I'm not shifting here on the lower time frame. So this means that I'm using the 1 hour. But let's say now it was the lower time frame. Of course, the first thing is make sure that the sweeping candle high, like you've placed a line there, and even if you shift into the lower time frame, make sure there is no break past this sweeping candle. I mean, yeah, past this high. So you will end up making the coach and whatever, but we'll be diving deep into that on the next session. We have multiple days that will be talking about the lower time frame execution, top-down analysis, and all of that. So worry less. And right here, this is a direct entry. So what I'll be waiting here is a reversal confirmation pattern or a reversal candlestick pattern, so that now it can give me the confidence to go down, or for that to give me that momentum that the sellers have stepped in, so that now I can participate with full confidence. So right here, I can clearly see this. Right, I will be talking about the reversal patterns probably at the end of the 4th entry module, but I guess I was to talk about them at the start of these entry modules. But all right, we will be diving deep into this probably after we have just finished the 4th entry module, that is the extreme POI mitigation, because I believe it's good also to capture this on the course. Yeah, it's crucial. All right, so the strong reversal candlestick patterns that I've been using, and they've been working great. They're the engulfing patterns, and all right, these are actually the first things that you get to learn when you get into trading. No matter if you learn support and resistance, trend lines, probably you will encounter these reversal candlestick patterns, and I believe most of you already know about these reversal patterns. So these are the ones that I have, like, they really work good, and also they are more often like to appear. So the strong reversal candlestick patterns, the first one is the engulfing pattern. This is a nice one, like the engulfing pattern. It can be a bullish engulfing or a bearish engulfing. So right now, if you don't know about them, I will not showcase the pictures because I didn't intended to, but you can check them out on any social media, like whether it's TikTok, whether it's YouTube, whether it's Google. But I will prefer you to go check them on YouTube, because there is detailed information about this reversal candlestick pattern, and probably you will even get more than these ones. So the engulfing pattern, there is bullish and bearish. There is the morning star pattern. Yeah, the morning star and the evening star, these are just good reversal patterns. There is the hammer, or we call this a bullish pin bar, and there is the shooting star, which we call the bearish pin bar. So these are just the ones that I am encountering like more often. Yeah, the ones that usually appear more often, and the ones also that they have been working real great. But you can clearly see here I put some etc. So this means that there is more reversal patterns that you will encounter, and I would recommend you to check them out, probably to get some head knowledge before we dive deep into them onto the session that we'll be covering after I finished the entry modules. All right, anyways, so right here I will be waiting for reversal confirmation, but clearly I can see this I can clearly see that this candle that wick above this one here, this is what we call like I will not say I will not call this a name because it's not perfectly as the one that I'm thinking, but you can clearly see that this long wick showcases some rejection of high prices, meaning that there is some selling pressure that is actually getting into the market. So this means you can clearly see the body is small compared to the wick. Yeah, you can clearly see the wing is long compared to the body of this candle. If this candle closed bearish, then this will be a very strong bearish confirmation or a very strong momentum to take the sell. But this candle closed bullish, so even though there is this wick that showcased some selling momentum, I will recommend you to just wait for another candle just to get that full confidence to get in. But you know that this next candle can close somewhere there, and this may reduce your risk to reward. So these are some of the drawbacks of using a direct entry. Your risk to reward won't be that huge, so probably we'll just be aiming for 1:2, 1:3, but sometimes you can get good trading ranges that may give you even 1:5. So just depends the trading range, but more often 1:2, 1:3. So right here, let me run price and see what price eventually unfolds. So we said that this high needs to be maintained. If now I see a candle that closes past this high, then the sweeping of this major inducement is totally violated. That's how you are. That's the reason as to why we need to write that line or just draw that line there. Because if we get a week, even not just a body closure, even a week past this line, I just recommend you to just leave that sweep. Like, just know that the sweep is violated, even though sometimes it may not. I would just recommend you to restrict yourself into what I'm actually saying here. All right, so right here you can clearly see price is now rejecting. So probably if I get a closure past this candle, I will take that entry. All right, so let's see. Price is all right, let me increase this so that it goes fast. Exactly. So on this candle, exactly right there, I will take my sell, stop loss, of course, above that high, and target 1:2. The reason as to why I'm extending past the external liquidity is because this one here is a major inducement sweep, and price more often go like travels insane after taking out a major inducement compared to a minor inducement. So there is literally uh, a sense in increasing, because we need to actually set our TP here according to the rules. We need to set our TP on the external liquidity, I mean on the opposite external liquidity, but you can clearly see the distance is not that huge. So yeah, we can do that. And also you can clearly see that this is a major inducement sweep, but if it was a minor inducement sweep, I wouldn't recommend. Right, so yeah, let's see what price does eventually. So let me make these 3 candles in a row. All right, and as you can clearly see, price is heading onto our direction and probably uh, hitting our TP exactly right there. So you can clearly see this here, like the risk to reward. This is 1:2. But if I had like took a lower time frame execution, probably I will get a 1:5, a 1:4, and also I may get like 2 to 3 trades here. Like, all right, I can get one, but sometimes you may even get 2 to 3 trades on the same swing point that you just like you just took a direct entry with a low risk to reward of 1:2. So yeah, anyway, we are just interested with the direct entry. We'll be diving into the lower time frame execution, so there's no problem with that. So let me get rid of all these. All right, let me just leave this. And yeah, so we all know that once price has taken out the major inducement and breaks past this swing point, which was confirmed after price took out this minor inducement, then this one here will be a break of structure, a valid break of structure to the downside. So this means that we are currently in a new trading range, and the trading range, of course, ranges from that high all the way to this low, currently at that low, but this low is not like confirmed to be called a swing point low. We say that swing point is only confirmed after the inducement is taken out. It doesn't matter the inducement if it's minor or if it's major, as long as it's taken out, then that swing point is confirmed. So all right, let me continue running price, and we can clearly see that price created that this here, this, all right, before price created this pullback, this one here was the inducement, and this here was the minor inducement, but then price created another recently formed valid pullback. So now it's a major inducement because this one here is the recent one, and this one here is just a random buy sell liquidity now. And for now it doesn't have much significance, because we said the core liquidity is the recent one, and of course, if you remember on our previous session, I said the other core liquidity is the engineering liquidity. So if this one here was the engineering liquidity, then that will be a core liquidity. Yeah, and that's true. This one is the engineering liquidity because I can clearly see the order block is right here, the extreme order block. So yeah, it was a core liquidity, but in today's session, I'm only focused with the inducement. So yeah, so right here, let me continue running price and see what price does. Right, so yeah, let's see what price does. Right, price is heading up. So let me just all right, let me delete all this data that is in below here. Yeah, let me just leave it. Yeah, let me just leave it like that. I like all right, let me hit this. Let me do this. All right, now this is better. So now I can draw the line here without any interference. All right, so that's the line, and this line is just just a low, random low. Not until price takes out this high, then I cannot confirm this one here as a swing point low. So let me draw this line. I can see some signal that price may end up sweeping this high. All right, I mean taking out that high because of that big momentum candles to the upside, and exactly right here we can clearly see that this candle did that. So right here, this here is our major inducement. You can clearly see that, and I said once that happens, this one here is confirmed to be a swing point now, and this one is our major inducement because you can clearly see that this here is the recently formed valid pullback. All right, let me rewind it. All right, let me just rewind it there. All right, so right here you can clearly see this here was the minor inducement, but then price created another recently formed valid pullback, and I said we are only focused with the recent one. So if this was the recent, then price creates the recent and then creates a new one, then we'll be shifting to the new one, and this one here just becomes a random buy side liquidity as long as it's not the engineering liquidity. Right, so this here is the minor, and we can clearly see that this here is a valid sweep. All right, I know this here is kind of some break, but you can clearly see this break is not with that large displacement. It was just a break, and I said it doesn't matter if it's a break by a body or a break by a wick. Just draw this candle. I mean the high of that candle, the high reached by that sweeping candle. Draw a line and make sure that line is not like there is no any other candle that will pass through that line. So that line is like our guard or whatever, like our protected uh like it should be protected for it to validate this sweep. So right here, this here, I can see this here was a body closure, but in this case, I mean, this is an exemption and this can be used as a sweep because number one, this sweep, like you can clearly see that this body, it was not like that huge, like a body that huge in that the closure was like right here. You can clearly see that there is a very huge displacement here, and this huge displacement literally says that this cannot be a sweep, but in this case the displacement was very less. You can clearly see like price just closed literally like a small part above this high, and after that it just gave that rejection to the downside, and this one here is one of a reversal pattern. I don't know its name, but you can check it out. This here, I don't know if it's tweezers or piercing line. I don't know. All right, so this one here is a reversal pattern, and in this case, I took this one here as a sweep, just like I explained. Like the displacement was very small, and also price just did that and gave a bearish rejection. So this means that the sellers have stepped in, and since a call liquidity is taken, so there is a possibility that price may end up making that ultimate low. I mean ultimate reversal towards this break. I mean towards this external liquidity, and this one here is the swing point low that we're looking forward to break past it. So literally after seeing that, of course, on the closure of this momentum bearish candle, that's where I would recommend you to place the entry and stop loss, of course, above that high, and target profit, of course, on the external liquidity. And since this is a major inducement, if this risk to reward is less, you can place some pips below, but I wouldn't recommend you like this to be the habit of you like extending this past this. If you can see like a good risk to reward, you can see that is a 1:4, a very good risk to reward. There's no need for you to extend it for 1:5 because a 1:5 sounds nice. No, don't do that. Just yeah, just do that 1:4. It's sufficient. 1:4 is a very big risk to reward. So, and also once you see the tweezer, and let's say you don't have like that big confidence, you can still run price and wait for the next bearish candle so that you can actually enter based on it. So it's not a must for you to actually if you think like you like, yeah, you can see now this gives you like literally the whole confidence that you need to enter into this trade. So if you think like this reversal, if you doubt the reversal pattern, just wait for the next candle that will print out like a bearish rejection, I mean a bearish candle. Then after that, yeah, do the same, but just know that you will now be reducing your risk to reward. So yeah, and you can clearly see now a 1:4 became a 1:2. So sometimes if you just see that this reversal pattern is like, if you clearly see that this is a reversal pattern, just take the entry. After all, it's a game of probability. You either win or lose. So yeah, so right here that is a 1:2, and yeah, after that you can run price, of course, and you can clearly see that price is doing that. So let me make it fast. All right, price consolidated. I hate these kind of trades where price is actually consolidating and all of that, but eventually you can clearly see that price made it out to the final TP exactly right there. So you can clearly see that price literally went nearly to the external liquidity, then price reversed back to our entry point, and you can clearly see some few pips before, like some few pips be like to our swing point high. I mean to our, well, like where we set our stop loss. So this means that and this is a practice that I see with some traders, that once they see like once they see some good rejection to or price going into their favor, they tend to take the SL to break even. Don't do that. Like please, please, please don't do that. I don't recommend it, and it costs me a lot. Like don't, I know you want to protect your money, but don't do that. After all, one thing, you will not, like, even if you set it to break even first, you will still lose on that because of commission and swaps. So like I don't think that's a good practice to do. And of course, sometimes price may just go back onto your entry and then get back to your full TP. And after all, like a risk management stop loss, like never give up on a risk management stop loss. As long as you calculated this risk, you're only risking 0.5, just set and forget. Leave the price action to do its thing. So guys, this is, you will literally do the same on the uptrend or on the bullish scenarios. So I was showcasing the bearish scenarios, and you will literally be doing the same on the bullish scenarios. So I believe we just got the context. The only thing that I would encourage you to go further at is the reversal patterns. Yeah, explore or learn more about the reversal patterns. Even though we'll have a session on that, probably I will not be covering like all the reversal patterns, or maybe I will not explain it as well as you get that knowledge from YouTube, whatever area you'll get the source, like whatever source you'll get the knowledge from. Probably you'll learn a lot there than the short whatever or the summary whatever that I'll be teaching there. So I would encourage you to go on YouTube or Google or whatever the source that you would like to, and get that knowledge on these reversal patterns, because you getting the knowledge of these reversal patterns will literally save you on this time when you are not sure about the reversal pattern and you need to wait for the next candle. And we said that if you do that, then your risk to reward obviously will be like small and all of that. So you can see if you had recognized this pattern, I mean these tweezers, so you can see that a 4, I mean a 4 is like a 1:4. So you can see just one candle ruined your risk to reward. So guys, this year was the first entry module, and yeah, I think I'm done with it. I said you literally copy paste the same on the bullish scenario. And yeah, I will end the session here. I believe I have made it clear, like the first entry module. And yeah, right now I am open to the questions.